Welcome back to Investing Talk Podcast. Today we are focusing on Krispy Kreme. And the big question, probably on your mind too if you've been watching the market, is this. Is Krispy Kreme stock a good buy right now? We're here to help you get informed quickly. So if you find this conversation useful, please take a second to subscribe, like, and maybe drop a comment. Also, definitely let us know if there's a specific company you want us to look into next time. Just leave it in the comments below. All right, so our mission today... Well, it's pretty clear. We've got a pile of analysis here. It covers everything, really. From those wild meme stock type rallies we've seen to the details of the company's own turnaround plan. We need to cut through all that noise, figure out what's really driving the value here. And maybe more importantly, where things might be headed in the next few months.
It's a really interesting setup, isn't it? I mean, here you have this brand. Everyone knows it, right?
Yeah.
But the stock itself, it's just been all over the place. You've got this massive retail enthusiasm hitting head on against some pretty serious fundamental problems.
Yeah, all over the place is putting it mildly. Volatility is the name of the game here. The stock's trading, quite a bit below its 52-week high. That was $12.68.
That's way down.
But, and this is the fascinating part, even though it's hovering down there, maybe low $3 range currently, it keeps having these, flashes, these huge upward spikes.
Explosive almost.
Yeah. So let's start there. Let's unpack that recent momentum. What's been driving these moves?
Well, okay, so there seem to be two main things pushing it lately. First, you've got that pure technical momentum, mostly from retail investors, it looks like.
Like the October 22nd jump.
Exactly. Shares popped, 13.8% in just one day. October 22nd, 2025. Huge volume. It was one of the most actively traded stocks that day. That's kind of the meme stock effect you mentioned.
Okay, so that's maybe noise,
yeah.
Short-term excitement anyway. What about the actual business? Anything more concrete?
Yes, definitely. The second driver is much more commercial. It's seasonality. We saw another massive jump, this one pre-market, over 30%. And that was driven almost entirely by the buzz around their limited time Halloween promotion back in mid-October.
Okay, so the themed donuts still work.
They really work. That kind of reaction from consumers, it just confirms how vital those seasonal campaigns are. They're a key part of their revenue engine, no doubt.
So we have these speculative surges and then this reliance on, seasonal sugar rushes, basically.
Yeah.
But all this positive movement, these spikes, they're happening while the company is, actively trying to fix itself, right? There's a bigger context here.
Precisely. And that's what this momentum feels so maybe fragile.
Yeah.
The company is right in the middle of a major strategic shift.
The turnaround plan.
Exactly. Management laid out this detailed turnaround plan back in August 2025 that came right after those Q2 results, which were, frankly, quite shocking.
We'll get to those numbers in a second.
You're right. But the plan itself, it's specifically designed to tackle really severe margin compression and just streamline the whole operation globally.
And that global piece seems pretty aggressive.
It is. They just announced back in September 2025 their first move into Spain. It's through a minority joint venture.
Interesting.
Yeah, management is clearly betting that accelerating these international openings and optimizing the store formats overseas, that's the path to long-term margin improvement. The idea is that, maybe international demand and efficiency can offset some of the struggles they're having domestically.
Okay, let's pivot then. Let's get into those financials you mentioned, because this is where it gets really tricky, I think. The top line looks strong. People are still buying the donuts.
Undeniably.
But those Q2 results were, as you said, shocking. So what's the fundamental picture right now?
Okay, the top line, you're right. It shows health. Net revenue was $379.8 million in Q2 2025. And if you look at the trailing 12 months, the TTM revenue, that's $1.54 billion. So consumer demand, global reach, that's not really the issue here.
Okay, wait. $1.5 billion in revenue sounds pretty good. How can a company pulling in that much be seen as, in trouble?
Because of what's happening below that revenue line. It's the profitability or lack thereof. Despite that revenue growth, Q2 2025, it saw a huge operating loss, $434.6 million.
$434 million. In one quarter.
Yep. And the net income for the TTM period, negative $451.42 million. So that massive Q2 operating loss, that's the single biggest elephant in the room. It's why that turnaround plan isn't just, a nice idea. It's absolutely essential.
Okay, hold on. A $434 million quarterly operating loss. That's catastrophic. How can analysts possibly still have a buy rating on this and project, 67% upside? What are they seeing that lets them look past all that red ink?
It's a fair question. They're essentially looking past that short-term, admittedly awful execution and focusing on what they see as the strong underlying structure and the potential for recovery. The consensus rating is still firmly a buy, and that median 12-month price target is $6.22.
Which implies, yeah, about 67% upside from where it is now.
Exactly. So the analysts believe the turnaround plan, which focuses on, cost cutting, taking a hard look at store efficiency, rationalizing the portfolio, they believe it will work. They're betting on the execution of that plan.
That takes a lot of faith, though. Executing a big, complex plan while you're bleeding cash like that. Do they even have the financial flexibility, the buffer to pull this off?
Well, according to the reports, yes, they seem to. They maintain moderate financial leverage. That gives them some breathing room, some flexibility to reinvest in the turnaround. And maybe significantly, they're still maintaining their dividend. It's 0.07 cents per share annually. Management seems to be signaling that, hey, despite that huge Q2 loss, they think the core structure is found enough and they can generate the cash flow needed through these operational fixes.
So what makes Krispy Kreme special enough for analysts to have that kind of faith? What are the competitive advantages? It can't just be about tasty donuts, right? There has to be something more fundamental supporting this belief in a margin recovery.
That's the key question. And there are a few things. First, just the sheer power of the global brand recognition. That gives them some pricing power, even in tough times.
Okay, brand helps. What else?
Second, and this is really crucial for that margin fix we're talking about, is their production and delivery model, the hub and spoke system.
Explain why that's so important right now, especially with costs going up everywhere.
Right. It's all about efficiency, particularly in this inflationary environment. This model lets them centralize the actual donut production in these hubs. Then they distribute the finished products out through their own stores, their direct-to-consumer platform, and importantly, those delivered fresh daily cabinets you see in grocery stores and convenience stores.
Oh, okay.
So in a world of high labor costs, high ingredient costs, having that centralized production is a huge structural advantage. It's something most typical quick service restaurants, your QSR peers, they just don't have at the same scale. That model should be the mechanism that drives the margin recovery eventually.
And they're trying to get more eyes on the brand too, right? Make sure people remember them.
Precisely. That headline sponsorship deal for the NASCAR 2025 season, partnering with Tide, that's a massive multi-channel push. It's about visibility.
Okay.
So you put it together, the brand equity, that efficient delivery model, the new visibility push, that's the engine analysts are betting on to pull the company out of this pretty deep operational hole.
Okay, so if the whole investment case hangs on pulling off this turnaround, when do we actually find out if it's working? What are the key dates, the milestones we should be watching over the next few months, the things that will either prove the bulls right or, well, derail this whole story?
Yeah, the next 3 months are absolutely critical. The first big one is coming up soon.
Yeah.
The Q3 earnings release on November 14th, 2025.
Okay, that's the big test.
That's the immediate test, yes. Investors and us, we need to see proof. Did those recent seasonal promotions actually translate into strong revenue? That's part one. But part two is arguably more important. Is there any evidence, any sign that those cost control efforts from the turnaround plan are finally starting to show up? Are margins improving, even a little?
Right. That's the bottom line, literally.
Yeah.
What happens after the earnings? What's on the calendar for December?
December brings a couple other things to watch. Around December 1st, you often have index and ETF rebalancing. That can sometimes cause some mechanical volatility, just buying and selling pressure that's not really fundamental.
Good to keep in mind.
Then around December 20th, we should get the holiday seasonal promotions report.
Yeah.
Given how much the company leans on these themed promotions, like we talked about with Halloween, that report will be a really important signal for consumer engagement. How strong is that momentum heading into the new year?
Okay, so earnings, potential rebalancing noise, holiday promo results. Got it. Now, if we look at the stock chart, the trading pattern, how do these upcoming events line up with the technical picture?
Well, the stock's obviously highly volatile. But interestingly, analysts note there's been elevated accumulation, especially after those recent rallies we discussed. People are buying the dips, it seems. So the sort of bullish technical range analysts are talking about for the next 3 months, factoring in things like short interest and that seasonal demand, it's projected somewhere between, say, $3.20 on the low end and maybe up to $6 on the high end.
So key levels to watch.
Definitely watch that support around $3.20. If it breaks below that, that's not a great sign. On the upside, resistance looks like it's around $4.50, and then that big psychological level, $6.
And given those retail surges, those meme stock-like moves, we have to talk about the short squeeze possibility, right?
A major factor here. The short interest is really high. It's sitting at 15.1% of the float.
Wow, that's significant.
It is. That's a huge number of shares being bet against the company. It provides a really strong technical tailwind if, and it's an if, but if those Q3 earnings on November 14th surprise positively, maybe better margins than expected, that huge short position could trigger a massive short squeeze, and that could push the price up towards those resistance levels, $4.50, maybe even $6, very quickly.
Okay, so lots of potential fireworks there. Now, beyond the official strategy, beyond the earnings dates, what's the gossip? What's the speculative buzz floating around on the forums, the unconfirmed stuff that keeps things interesting?
Ah, right. Well, there are a few recurring themes, rumors really. First, there's persistent talk about a potential strategic partnership, maybe with a big international coffee chain.
Ooh, that would make sense, wouldn't it? Given their push overseas.
It really would. Instant amplification of their reach. Second, there's ongoing chatter about maybe closing some U.S. stores, reallocating assets, basically.
Right.
Shuttering less profitable U.S. locations and putting that capital into maybe better urban spots or those international markets.
Streamlining, yeah.
Third, you hear whispers about possible exclusive deals, maybe product collaborations with some of those big tech-enabled food delivery companies, trying to boost digital sales.
And the fourth one? Is it the usual suspect?
It usually is in these situations.
Yeah.
Persistent rumors of a private equity buyout. The thinking goes, right, if the stock stays this volatile, if the market cap stays depressed compared to the actual global brand value, well, it starts to look like an attractive target for a PE firm, or maybe even another big food company looking to come in, fix the operations, and unlock value.
Okay, lots of potential upside catalysts, confirmed and rumored. But we have to balance that. Let's talk risks. What could actually stop this turnaround cold? What are the specific dangers here?
The number one risk, hands down, is execution risk. Plain and simple. That $434.6 million Q2 operating loss isn't just a number. It's proof that the margin problem is real and it's deep. Trying to execute a complex turnaround plan across dozens of countries, multiple sales channels, it's incredibly difficult. Even management has acknowledged how challenging rapid international growth is, managing complicated supply chains. The complexity itself raises the odds that something goes wrong, that they fail to execute effectively.
And are there broader industry risks they still have to deal with?
Oh, definitely. They're not immune to the headwinds hitting the whole quick service restaurant sector. Things like cost inflation, ingredients, packaging, and, of course, labor shortages and wage pressures.
But you mentioned their brand might help there.
Exactly. Their strong brand equity probably gives them a bit more pricing power than some competitors. They might be able to pass on some of those costs without losing too many customers. And that hub and spoke model helps with efficiency too. So they have some resilience, but the sector risks are still very real.
Okay, let's try and pull this all together then. We've got this huge margin challenge, highlighted by that massive Q2 loss. We've got an aggressive turnaround plan focused on cost cuts and international growth. We've got strong backing from analysts, surprisingly strong maybe, and this powerful technical setup with high short interest. So what's the final thesis? Where do you land on this?
Overall, looking at everything, the thesis leans bullish. I'd rate the potential pretty highly, actually. And that's based on really four main pillars.
Okay, lay them out.
One, the turnaround plan isn't just talk. It has concrete milestones we can track. Two, you've got strong seasonality working in their favor right now, plus those imminent Q3 and Q4 catalysts we discussed. That positions the stock well for a potential near-term re-rating if things go well.
Right.
Three, underneath it all, you still have that powerful global brand and a real strategy for international expansion that supports a genuine multi-year growth story if they execute. And four, you can't ignore the strong analyst consensus and that $6.22 median price target. It provides a sort of validation for the upside potential.
So putting it all together, who is this stock actually for? Is it just a gamble for short-term traders, or is there a case for long-term investors here too?
Interestingly, I think it actually appeals to both camps right now. For short-term traders, the high volatility, those upcoming catalysts like the earnings report, and especially that short squeeze potential, it's very attractive. There's definitely opportunity to trade the swings over the next quarter or so.
Okay.
But it's also positioned for longer-term investors, the ones who are willing to look past the current mess and bet specifically on that structural growth story. The ones who believe management can execute the turnaround over the next, say, 2 to 3 years and unlock the value of that global brand and footprint.
So it really boils down to that turnaround plan again. Execution, execution, execution. And that Q3 earnings report on November 14th, that's going to be our first real clue, our first test to see if the cost controls, the international push, if any of it, is actually starting to heal those really bad margins.
That is absolutely the crux of it. The market seems to be pricing in some expectation of success right now, but November 14th, that's when we get the first piece of hard evidence.
Which brings us to our final provocative thought for you, our listener, to think about. The stock right now seems supported by two different forces. You've got the analyst targets and that significant short squeeze potential pointing towards maybe a near-term technical boom, perhaps driven by retail excitement. But then you have the fundamental recovery actually fixing that huge operating loss, which might take several more quarters, maybe even longer, to fully play out. So the question is, which signal do you trust more for your own investment strategy right now? The potential technical fireworks or the slower, more uncertain path of structural margin recovery? Something to mull over. Thank you for tuning in and exploring all this with us today. We really appreciate you joining the conversation. We'll be back soon with another analysis.